I gotta tell you, there isn't anything better than kicking your shoes off, sipping a fruity drink, sitting back while watching BTP Fusion and growing your wealth. Nothing beats passive income, and more to the point, nothing beats automated passive income. In this video, we're gonna go over the robo-investor wars and talk about how you can benefit. So sit back, relax, kick off your shoes, grab a fruity drink, and enjoy this next episode of BTP Fusion. What's up, you guys? You're watching BTP Fusion. I'm your inspiring, aspirational host, Derek West. Here in BTP Fusion, it's our goal to inspire you to take action to improve your personal finances and business using the power of technology. If this is your first time here, I think you're going to like it. If you're coming back, welcome back. You know how we do it here. And with that, let's dive right in. Robotic wars. You tend to think of post-apocalyptic futures with mechanized androids duking it out for the survival of the species. Visions of shiny, metallic, laser-wielding techno-overlords come to mind. Or maybe that's just me. But our robotic future isn't all doom and gloom. Also, when you come to think about it, it isn't little trinket robots doing cool tricks and automating assembly lines either. It can be automating your investment life and investment habits. I bet you're wondering to yourself, Derek, what do you mean? Quit teasing us with all this cool information and get to the point. Fine. So for the uninitiated, robo-advisors, or robo-investors, my preferred moniker, are apps or software that automate your savings and investments. These online financial companies use sophisticated software instead of human stockbrokers to manage your money. In that way, they keep their costs low. Robo-investors mainly use ETFs, exchange-traded funds, to build a diversified portfolio. An ETF is a collection of stocks and bonds, so it's less risky than single stocks. ETFs also cost less to trade, so that means the portfolio is cheaper to maintain. The thing is, they aren't new and have actually existed for over a decade now. The two pioneers in the space, and probably the best known companies in the space, are Betterment and Wealthfront. Launched in 2008, Betterment is considered the pioneer of robo-investing. Its main competitor, Wealthfront, moved into robo-investing in 2011. Both of them are competing fiercely for market share with each other and also with newer entrants into the space. They work by essentially finding out more information about you, things like your age, when you hope to retire, and your tolerance for risk, all key data points to understand when you're trying to invest. Both companies use software robots, in reality just proprietary programs that act as automated advisors to steer your investments and cheaply do things that stockbrokers and money managers would charge you higher fees to do. While Betterment and Wealthfront are probably the leaders in the space right now, there's literally hundreds of them. In fact, if you're technically savvy enough, you could probably make your own. That's a topic for a completely different video, however, and it might be a topic for a completely different channel. But in any case, be sure to like and subscribe so that you're the first to know when that video drops. But back on topic, robo-investors/advisors really shine in a couple of ways. First, low fees. Keeping fees low is key to maximizing the investment axiom. It's not what you make, it's what you keep. The less fees you spend for your investments, the more you keep. And robo-advisors of all stripes really help you to do that. These algorithms help to take the emotion out of investing. If you have ever invested in a stock only to see it go down, at which point you get out of that position, only to see the stock go back up, then you know that human emotion can really affect your investments. And this is where robo-advisors really come in. The key, though, is that you let the advisor do its work. And that really is the hard part, just letting go. But another reason that they're great is they're expanding the investing marketplace. If you think about it, everyone should invest at least some of their money. Some folks, younger investors especially, or those with lower net worths, may not have considered professional financial advice heretofore. Robo-advisors are growing the existing pool of people who feel as though they're qualified for financial advisory services. Because of the easy access and lower fee models for professional financial management, more people will probably choose robo-advisors professional management in lieu of the do-it-yourself model, which can be scary and sort of a mystical black box for a lot of people. Robo-advisors are customizable. Everybody loves to customize. And not being cookie-cutter is one way to avoid group or herd mentality that oftentimes is the cause of massive corrections or recessions. Here's a couple of examples. If you're interested in a certain sector or investment theme, then Motif's 151 existing portfolios offers a platform for you. Motif excels at giving their users many idea-based portfolios, from a shale gas portfolio to a fight fat portfolio, offering to investors a portfolio of weight loss companies. They also have a caffeine portfolio that coalesces coffee-related companies for you. If your primary concern is rock bottom fees, there are several robo-advisors with broadly diversified low-fee ETF portfolios. There are robo-advisors that claim rebalancing and tax-loss harvesting in their arsenal. There are also single approach and hybrid style robo-investors. There are some that actually have higher barriers to entry, like some that have a $100,000 minimum entry fee. So that's not necessarily for your new investor. But that said, even robo-advisors with high entry requirements are more accessible than the financial advisors with $1 million portfolio minimum. Talking about minimum balances, most robo-investor platforms have low minimum balance requirements. So robo-investing is a boon for investors with a small net worth, allowing them to get professional robo-advisory management for a very little upfront cost. So it can't all be good stuff, right? With any good thing that comes around, there's always trade-offs. And that's especially true for technology that is relatively untrusted. So what's the downside with robo-investors? Robo-investors can be somewhat simplified. Simple is good, right? Yeah, sure. Simple is good, but keep in mind that there are completely legitimate investment strategies that can get somewhat complex. If you want to sell call options on an existing portfolio or buy individual stocks, most robo-advisors won't be able to help you. There are sound investment strategies that go beyond an investing algorithm. Sophisticated and newbie investors may want a broader investment portfolio with a wider range of asset classes, than a typical robo-advisor would offer you. If you look closely, they cost more than all-in-one funds. Robo-advisors are typically pretty cheap, but they do still cost more than the lowest cost all-in-one funds available. For example, Vanguard's Target Date Retirement Fund cost about 0.13% and 0.16% per year, and their Life Strategy Fund costs 0.12% to 0.15% per year. Betterment, on the other hand, charges 0.25% for its baseline management fee, plus the cost of the underlying investment, which, for most portfolios, will be around 0.10%. That's a total cost of around 0.35% per year. That's not a huge difference between the two, and even with the management fee, Betterment is much less expensive than most other investment options out there. Still, it's worth knowing that there are cheaper ways to get an all-in-one portfolio. So this is true of any investment, so it's not specifically a knock on robo-advisors, but some of the marketing may make it feel like they are guaranteeing a certain return, and that's really not the case. Robo-advisors can expose you to just as much risk as any investment. Sometimes your returns will be great, sometimes you'll lose money. That's just the way it is with any investment. Now, keeping that background in mind, let's go over the best-known robo-advisors and see which one truly shines. Betterment is considered the oldest robo-advisor and has grown to be the best known in the space. Betterment is trusted by many folks, and millennials especially, and thus they have 13.5 billion assets under management, making them the largest independent robo-advisory firm. I did say independent, so keep that in mind for the next couple in this list. Betterment customers get access to tax-loss harvesting to squeeze out an even bigger gain on their portfolio. Betterment offers accounts with annual fees ranging from 0.25% to 0.4%, with up to a free year in management depending on the size of your opening deposit. Most accounts have a 0.25% fee, though premium accounts are available with additional features for accounts over $100,000 in size. There is no minimum balance to open a new account, making it particularly attractive to new investors without much to invest. Wealthfront's claim to fame is its reliance on modern portfolio theory to build portfolios of low-cost ETFs. It also offers direct indexing for accounts with $100,000 or more, which mimics ETFs with direct investments in stocks to capture the greatest tax loss harvesting benefits. By the way, I've said tax loss harvesting a couple of times in this video, so that indicates to me that it might be a good subject for another video. But suffice it to say that this makes them a winner for tax management as well. The majority of accounts pay a low 0.25% management fee. ETF fees charge a weighted 0.08% APR, among the lowest rates out there. The first $5,000 you deposit is managed for free, which makes Wealthfront the top choice for those looking to test out the waters in robo-advising. You can put in a very small part of your portfolio, or the whole thing for a smaller portfolio, without paying a penny in management fees. You'll still pay mutual fund or ETF fees, that said. So far, we've talked only about companies that focus exclusively on robo-advising. But major brokers are even getting into the mix. Charles Schwab's Intelligent Portfolio is the robo-advisor product from Charles Schwab. Now, Schwab is a giant in the investment industry with $3.36 trillion in assets under management. Of that $3.36 trillion, $23 billion is in robo-advising accounts, making them the largest robo-advisor by total cash volume, but one that's not exclusively dedicated to robo-advising. The thing that makes Schwab's Intelligent Portfolio most noteworthy isn't necessarily the management company, it's the fees. Schwab charges no advisory or management fees for Schwab's Intelligent Portfolio. And you can open an account with a $5,000 opening minimum balance. Like other robo-advisors, you'll fill out a survey when you sign up, look at your goals, risk tolerance, and timelines. From there, Schwab takes care of the rest, putting your funds into a diversified portfolio of ETFs. Schwab's Intelligent Portfolios use tax loss harvesting and automatic rebalancing, among other tools, to give investors the best possible deal. So be sure to click that notification bell so that you're notified when new videos drop on all things tech, personal finance, and business. Also, leave a comment down below if you are currently using a robo-advisor or if you plan to use one. We'll talk to you guys in a little bit. Take it easy.